Hello and welcome to our monthly trade floor update for July. I'm Hugh Holden. I'm joined today by Portfolio Manager Aditya Thacker. Aditya, welcome.
G'day Hugh, how are you?
Very well, thank you. Slightly different setting for us today as we and a lot of the country experience lockdowns of various lengths, but the show must go on. Bonds wait for nobody, and there's a lot to talk about today. We've mentioned on previous updates that we expected the Reserve Bank meeting for July to be an important one, and they didn't disappoint us. They announced a range of updates to their policy measures. They left the cash rate unchanged at 10 basis points and also will continue to keep government bond yields anchored at 10 basis points out to the April 2024 maturity as part of their yield curve control program. Their term funding facility ended as expected on June 30th, but perhaps the main surprise from their announcements came in terms of their quantitative easing program. And once the current tranche of QE ends, they will continue it, but at a reduced pace of $4 billion a week instead of $5 billion a week. And that'll be reviewed in November, which is about a month earlier than we were expecting or than markets were expecting. So Aditya, a lot of information there, a lot of announcements. How do we interpret all of that? Did that come as a surprise to the market or to yourself?
Well, I think for the most part, the market was expecting what they delivered. And when you look across the market reaction in both interest rates and foreign exchange, the moves were fairly well contained, which suggests that the market was pretty well prepared for it. Essentially the RBA were acknowledging the faster pace of recovery that we have seen, particularly in the labour market. And that's why they've now begun to communicate to the market, what their process will be, what their slow and cautious process will be for removing policy support, once the economy no longer needs it. And this is a theme that has already been echoed by other central banks around the world, like the Fed, the Bank of Canada, Bank of New Zealand. So in that respect, what they did, there was nothing particularly exceptional about the RBA, what they did. And in fact, you can say that they still remain one of the most dovish central banks around the world, which is great for Aussie bond investors and also great for our economy. But as you mentioned, there were a couple of aspects to the meeting which were a little bit more hawkish. Firstly, they did underwhelm on the third tranche of QE, both in terms of size and scope. And secondly, they did soften their language around their forward rate guidance. They still expect the first interest rate hike to come sometime in 2024, but they dropped the phrase "at the earliest." So suggesting that they're just giving themselves a little bit of optionality to bring forward that rate hike into 2023 should the recovery continue, above expectations. But overall, I think based on the overall market reaction, you can say that it was pretty well expected and priced by the market.
Just in terms of the market reaction and what was priced, I want to pick up on something you said with regards to other central banks around the world as well, because we saw in June in the US, for example, they had really quite a high inflation print and their central bank, the Federal Reserve, brought forward their expectations for when they expect to begin raising interest rates. But yet government bond yields there actually ended the month lower than when they started. And as you mentioned, again, with the Reserve Bank's announcement here in July, bond yield, the bond market took it without a big reaction. So, perhaps counterintuitively to what some of our clients might expect, or that may be surprising for some of our clients. How does that work? Why is the market reacting in this way to some of these announcements from central banks?
Yeah, it's a little bit perplexing, but we have to always remember that the market is very forward-looking. It's already pricing in a lot of tightening and pricing in rate hikes beginning much earlier than what central banks like the RBA are forecasting themselves. So hence, yields have been relatively range-bound and actually going a little bit lower in yield and well below the previous highs that we saw in yields earlier this year in Q2. I think when we went into this meeting, we thought that the RBA, what they would deliver, wouldn't really change the total number of hikes that the market is pricing in over the entire cycle. But we felt that the risk was that the starting point for the hikes would be brought forward a little bit and priced a little bit earlier. So we went into the meeting, underweight short maturity bonds and overweight the intermediate part of the yield curve, the 5 to 7 year part of the curve, where interest rates already reflect that total number of rate hikes over the cycle. Luckily, that's pretty much how things played out. Because the total number of rate hikes didn't really change after the meeting, long-term interest rates, like the 10-year interest rate, didn't move that much, because after all, they simply reflect the market's expectation for the average cash rate over that entire 10-year period. So if the total number of hikes doesn't change, that doesn't change too much. But the fact that the hikes were brought forward a little bit earlier, that did see a bit of an underperformance of short maturity bonds relative to longer maturity bonds. And as I mentioned earlier, that resulted in what we say the yield curve flattening. Now looking ahead, we think that this kind of thematic still has a little bit more to play out. So we haven't really, positioned differently after the meeting. We've kept most of these positions on. And we think that will persist for a little bit longer, particularly as the recovery continues at a pretty strong pace.
Final quick question. You mentioned markets are forward-looking. So just for the viewers, what is the Australian bond market now pricing in terms of interest rate movements?
So the first full rate hike is already priced by October 2022. And looking a little bit further out, we've got about six rate hikes priced by the end of 2024. And even a bit further out from that, we've got terminal rate pricing, or the end of the cash rate cycle, being somewhere around 1.75 to 2%, which we think is, roughly fair. Overall, we don't think that bonds are, particularly cheap. We think that they're close to fair value. So we're not advocating a particularly strong or long bias in our positioning. We still see some risks around inflation and growth in the second half of the year, but we think that the majority of the move that happened in the earlier part of this year is behind us now.
Okay, that's excellent. Thanks, Aditya. Appreciate your time, and thanks everyone for joining us. We hope you found that useful. If you do have any questions or would like any more information, please contact your local PIMCO account manager or visit our website at pimco.com.au. Thank you.